Hi there, it's Dave Keller here with Market Misbehavior. I was asked in a recent video, what are the charts hanging in the wall behind me? And usually when I do videos, I have some sort of angle like this, and I've got some charts going on in the background. And what I wanted to do was actually show you what those four charts are. There are two that are usually behind me. There are two that are off camera to the left. What I'm going to do is probably completely mess with my lighting, but I'm going to show you the four charts and one lesson from each chart. So for today, it's 4 lessons from 4 charts in my office. So you may ask, why do I have big paper charts hanging in my office? This is absolutely comes from my experience at Fidelity. One of the great pleasures of my career thus far has been running the technical research team at Fidelity up in Boston, and we manage the Fidelity Chart Room, which is this incredible physical repository of market history and devoted really to technical analysis, to analyzing price behavior and sentiment and breadth readings and other things. And I gained so much, I feel like, as an investor, as an analyst, just from wandering around this room with huge wall-sized paper charts. Now, one of the really cool things about my time there is we incorporated a lot of new technology, multi-touch screens, big, huge digital displays to really elevate a lot of the great content in the space. But for some things, having big paper charts actually still really worked. So it's funny, actually, what I'm looking at behind the camera are my screens. I've got 4 computer monitors here, and I'm always looking at lots of charts, hundreds if not thousands of charts every day. But sometimes when things get confusing, when things get noisy, it's actually really helpful to take a step away from the flickering ticks of the live markets and just look at these long-term charts and focus on the message of the long-term trends in the markets. Before we get to the 4 charts, what they are, why I have them, and what they're telling me, I wanted to encourage you, if you like this sort of thinking about investor behavior, decision-making, market history, and the lessons we can learn from previous market cycles, I hope you'll subscribe to my channel, hit the little bell to get a notification when I add a new video. We have new content on here every week. Also, if you like the video, you appreciate the content, give us a thumbs up if you would. We'd really, really appreciate it back. Finally, put a comment below the video. Which of these 4 long-term charts do you think is most helpful in having a proper long-term perspective? At the risk of messing up my lighting and changing camera angles, let's get to the charts. All right, so here we are. You're getting sort of a behind-the-scenes look at market misbehavior. I hope no one is offended too much by the general lack of organization or cleanliness as I'm looking at the image in the monitor here. And you'll find a lot of random things in the background of my office, and everything there has a purpose for some reason, usually related to some combination of music, mindfulness, or the market. So for example, in the back corner there, it's a didgeridoo and an antique airplane propeller balanced in the corner of the room. Everything over here on the bookshelf has some special meaning in one of those areas. So maybe when I hit like 10,000 subscribers or something, I'll do a video and just focus on each of those items and what they mean, because I guarantee there are some good investment lessons in there. But this video is focused really on the charts in the background. The 2 that you see here are the ones that are usually in the background when I shoot my videos here. And I should mention all of these charts, the 4 charts I'm going to show you, all are produced by SRC StockCharts, that's Securities Research Company. They do a great job, and they have for decades, creating visualizations. And if you know anyone, or if you've been involved in the markets for a long time, for a number of decades, or if you have any mentors or others that have been in the markets for a while, they can tell you most likely about the SRC books. They had a green book and a blue book that they produce regularly. It might have been once a week, but I think it was more once a month, I think, if I remember right. But sorry, it's been a while since I've had my hands on one, but I have met with mentors of mine that used to get those books regularly. And if you didn't have a team of analysts, or if you didn't take time to hand chart every chart of the stocks that you were looking at, that was the way, that was your way of seeing how the markets were looking visually. So it's interesting now when we have access to so much great visual content online, and obviously at StockCharts.com, I'm very familiar with the power of visualization and what we can do using the computing power now. But it's fascinating to see what sort of visualizations you were really able to do, which were incredibly, there's so much market wisdom embedded in these charts. And the charts you're seeing here are produced by them for my office, which are beautifully done and illustrate really long-term market history. So these are charts that really don't need to be electronic. They're beautiful in paper form and I think the data will speak for itself. The first chart we'll talk about is on the left there, and that's the long-term stock market averages. It starts in 1971 and really goes to the end of 2020. I'll zoom in here so you can see the content. But basically, the lesson on a chart like this is basically to understand that the market moves in cycles, as a reminder that there are bull cycles and bear cycles. And while we oversimplify a lot of times and think about the long-term trajectory in the markets, which generally for equities, of course, has been very, very positive. The fact that we're at all-time highs again this week is a reminder of the long-term ability of the markets to generate wealth. But this chart in particular, because it hits on the different averages and what their experiences have been, right? Where your experience has been as an investor owning, if you owned those charts for the last 50 years, it's a great illustration of, for example, the bear market cycle in the 1970s. When I look at that chart, that's what usually jumps out at me, is that 1970s bear market. And if you look at how long it took once the Dow hit 1,000 and then stayed around that level or below that level for, I think, 16 years, if I remember right, before the 1982-83 period when it finally broke above 1,000 and then continued on there for good. But that was a long amount of time for by the time from the moment it first reached 1,000 to when it finally broke above there. So it's a reminder of how long bear market cycles can be. I started in the industry in June of 2000. The market topped in March of 2000, and so my introduction to investing and to technical analysis was during a period when the markets were in a secular bear phase. And so I learned a lot about risk management and how to use charts and technical analysis, not just to identify winners or potential winners, but to manage risk and to protect against capital loss. And that chart, I'm always drawn to the 1970s. Which are sort of on the left side of that chart, and the importance of that break to new highs in 1983. And then after that, the resilience of the market in the 1980s and 1990s, that a secular bull market can last way longer than you expect. And right now we're arguably in the middle of one of these bull market runs. So, if you find yourself calling tops all the way up, a period like the 1980s, the 1990s, or even the 2010s can be a very painful period. So that's the lesson from chart number one. All right, we rotated a bit here to see chart number two, which is on the right. This is a long-term chart of interest rates, and it's very timely to have the long-term chart of interest rates given where we're at right now, where we have the Fed meeting this week. We have a period of historically low interest rates, and what this chart shows you, taking interest rates back from 1915 to 2020, is to look at the incredible rise in rates, right? The multi-decade bear market in bonds, the rise in interest rates into 1980s, and then the 30-year plus bull market in bonds as interest rates come down. What that chart reminds me of, or makes me think of, is that anyone who's been investing, if your investing experience has only been after 1980, if you've started investing in the 80s, 90s, aughts or knots or whatever we call the 2000s and 2010s, the teens, you've never really invested in a rising rate environment. And for me, I'm always thinking of what environment are people not prepared for, either with their capital or emotionally or both. And I would argue a rising rate environment is one particular set of circumstances that I think most investors investing today, especially any younger investors, have never really seen. I haven't seen that either. I started investing in the early 2000s, and so I've not really been part of a rising rate environment. That has a whole different set of assumptions, a different set of circumstances, different potential headwinds and tailwinds, and I think one of the big ones potentially is the long-term underperformance of the financial sector. If you look at a chart of the financial sector in recent years, it's a chronic underperformer, and think growth areas like technology and others have done so much better. But if you get to a rising rate environment, you get to a steepening yield curve, you get to a position where banks are better or in a much better position to profit from the interest rate environment, you could all of a sudden have more of an outperformance in the financial sector, which is something we've seen in the last 6 to 12 months here in the current market environment. So that is a reminder that interest rate regimes can be very, very long term, but it's also a reminder that we've been in a falling rate environment for so long that I think a lot of investors are underprepared for a rising rate environment. It makes me want to dig into some of those historical periods before 1980 to see what the market might be like. Are we now in sort of the 1950s, for example? Well, I think I'm single-handedly in one video breaking all rules of video production, so I hope this comes out okay. I hope to get better as a videographer. I'm on my own in my home office, so I hope this comes out well for you and you're getting a good experience thinking about some of these long-term charts. Chart number 3, by the way, is sort of the bottom, and this is usually off screen for me, and these are important because when I'm doing my work, I'm actually sitting behind the camera over here. I'm aimed a different direction, so these are the charts that I can actually see in my peripheral vision at all times. The first two we talked about are in the background, so I don't look at them a ton. The ones that are over here, I thought were important enough that I wanted to keep my eye on them and just have them as good reminders of what was going on. So the bottom chart here on the left wall is basically looking at earnings versus price. And it's a 100-year chart, so it starts in 1921, goes to 2021. And it's actually called the 100-year chart of U.S. economic and corporate growth. But to me, it really speaks to the relationship between price and earnings. Earlier in my career, I worked with a lot of institutional money managers, and they were big on focusing on earnings trends, right? If you can get the earnings right, you're going to get the stocks right. If you can get be on the right side of earnings and figure out which companies are going to grow, the price will follow, and all you need to do is focus on getting the earnings correct. And that's good, that works as long as price follows earnings, which is a major assumption that you're making there. What that chart tells you is over the long term, that is absolutely right. Over the long term, companies have been able to grow earnings as a whole. The market as a whole has grown earnings. And of course, as we know, the S&P 500 or the Dow, whatever index you're using, has appreciated over that period. So by that broad zoomed back metric, it absolutely works. Earnings have grown, price has grown as well. But the kicker is, depending on your time frame, that's not necessarily the case. So there are times when price actually leads earnings, when the market leads earnings, when the market appreciates, and earnings actually lag behind a little bit. They actually don't recognize the strength until a little bit later. It's almost like the market anticipates growing earnings. There are other times when earnings grow and price does not. And again, it all depends on your time frame, right? Depending on different periods of time, depending on your investment horizon, actually might not work. So it's a reminder for me that when you think about technical analysis, when you think about charts, you need to think about it in different time frames. For me, there's a short-term time frame of a couple of days to a couple of weeks, a medium-term time frame of a couple months to a couple years, and then a long-term time frame, multiple years and beyond. This chart, I think, speaks to the second and the third time frame. It speaks to the long-term time frame, which means if you're going many years out, absolutely look at stocks that are growing earnings and that you expect to continue to do that. Overall, you're probably going to do just fine because in general, the market has appreciated and companies have been able to grow earnings over time. But it also tells me about that medium-term time frame to think less about earnings and focus more on price itself. Because in the short term, the market is a weighing mechanism. In the long term, no. In the short term, because in the short term, the market is a voting mechanism. In the long term, the market is a weighing mechanism, as it's been said. And so, focusing on that medium term, it's less about the weight of the evidence of the fundamental data and the company's ability to generate earnings. I would argue it's more about the supply and demand. It's more about the fear and the greed and how the price starts or goes from its current starting point to the fundamental value that it should go to. So this chart in particular helps me think a lot about the relationship between fundamental and technical data and think about the time frame. Make sure that my analytical process is focused on the proper time frame. All right, we're to my fourth and final chart. This is called the New Century chart. This actually goes from 1906 to 2021. It's the deepest history that I have here in the home office, and it's a beautiful illustration of the long-term trend in stocks. It illustrates the fact that overall stocks have been in an uptrend. Couple takeaways. One brief takeaway first off is a mentor of mine, Ralph Acampora, always loved to highlight the quote that the market takes the escalator on the way up and the elevator on the way down. So if you look at that, you'll see that trend of uptrends and then corrective moves of sell-offs that are tend to be more sudden. So it's a great reminder of just the suddenness of bear market activity, that overall, even though the trend has been positive over the long term, there are periods where there are pullbacks and they can be sudden and painful and difficult. But the real message of this chart is that overall, the history of the equity markets in the US and really globally is a story of expansion. It's a story of economic growth over time. If you look at this chart, you'll see that the markets themselves have grown, earnings have grown, GDP, GNP, whatever has grown. All of those things illustrate the long-term ability of equities to generate wealth. So to be honest with you, it reminds me, because I learned technical analysis in a bear market phase. I learned how to chart in the 2000s, which was a secular bear market. It was the popping of the tech bubble, the unwinding of a lot of investment theses in the 80s and 90s, the end of that bull market phase. And it was a lot of pain. It was a challenging period. And so for me, it was a lot about risk management. But it's difficult to be bearish all the time when you see that that's the long-term trend in the market. So it's a great reminder that overall, my bias should be long. My bias should be a growth story. My bias should be assuming that the market is going to go up until proven otherwise. A lot of times I tend to approach bull markets with skepticism. I tend to treat the market as guilty until proven innocent and assume that we're going to top out until I'm surprised by the fact that we don't. Charts like this, and the reason why it is the most visible from my desk, is to help me remember to think about that overall. If I'm bearish, I am fighting the long-term trend, and it's a good lesson if you like to play the short side. If you're playing the short side, that can work temporarily, but you are fighting against hundreds of years of market history where equities overall have appreciated. All right, we made it back to our starting point. We're back at the normal angle that I shoot for videos, which is the well-curated background and a couple pretty meaningful charts in the back. I hope that you realize now, as I've walked through these 4 charts in my office and 4 really good takeaways from each, or 4 takeaways altogether from looking at those 4 charts. I hope you realize that charts in the background are not just for display benefit, although I think they provide a healthy backdrop for our discussion about market history and investor decision making. But I hope you see now that each one of them was selected for a particular reason. They each have meaning, and they remind me of 4 key lessons to keep in mind as a long-term investor. If this sort of thinking about investment decision-making, charting, technical analysis, investor behavior is of interest to you, I hope you'll subscribe to my channel. It'll be so fun to have you along on this journey with us. Also, give the video a like if you appreciated it. We would very much appreciate it back. Finally, put a comment below the video. Which of those 4 charts spoke to you the most? Which you think is most important for long-term investors to keep in mind today? From everyone at Market Misbehavior, I'm Dave Keller. Be well, stay safe. We'll talk to you again soon.